Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He worked in the oil industry for decades, including as a senior executive at Hess Oil for many, many years. He is currently the president of the Energy Prospectus Group, a networking organization based in Houston, Texas. Dan Steffens, thank you for joining me again.
Yeah, glad to be back.
So, Dan, we're recording this interview on Thursday, April 6, 2023. We've had actually a rally in the last 10 days with the West Texas Intermediate crude oil prices back up to above $80 a barrel. Natural gas in the U.S. natural gas price is still very, very low over the last 4 or 5 months, down to around 2. I want to get your thoughts, though, over the last 10 days, 2 weeks on the oil futures contract price, because the oil futures contract price was just looking abysmal up until this recent rally and the Saudi OPEC production cut announcement. Did you think that was the washout when the West Texas Intermediate hit $67 about 10 days ago?
Yeah, it got down there. It was trading in a pretty tight channel between about $74 and $81 a barrel. And then it just, broke through the bottom of that. And then I think OPEC felt like they had to do something. So we got the OPEC production cut. And there's several reasons behind that production cut, and I think that they are definitely going to defend the price of oil. Number one, they need oil prices above 75 just to break even in their economy over there, and that's one thing. But also, I think they wanted to send some clear messages to President Biden's team. I think they were really upset that the U.S. had said that when oil prices dropped that they were going to refill the SPR. And then they came out and said, no, they weren't going to do that. And I know that really pissed them off, and they were expecting that to happen. So they said, okay, well, we'll take care of this. We'll step in. And they cut production, or announced they're going to cut production by 1.6 million barrels a day starting on May 1st. Now, part of that is just a recognition that some of the OPEC members actually can't make it up to their current quotas anyway. So, but this is may have a bigger impact than their original cut of the 2 million barrels a day, which was clearly just an adjustment of their quotas back to reality. This is going to be a real cut, and will probably take over 1 million barrels of physical oil off the market. And I really think, and what's kind of interesting, it sent the price of oil in the futures market right back up to 80, 81, which was right at the top of that trading channel. And I think as soon as we get more evidence that demand for oil is exceeding supply, which is definitely happening in the second quarter, that you're going to see oil break through that ceiling of that channel. And once it does, that'll make 80, 81 the new floor. And then there's no technical resistance between there and 90.
The International Energy Agency, to back you up on this, with oil demand starting to exceed supply and taking away a lot of those inventories that are left. There was an article out about a couple weeks ago summarizing the International Energy Agency on oil price. Global oil demand will outstrip supply in late 2023. But that's, I think, how the charts have looked over the last. I was talking about this back in January, where I expected the oil price to be weak for a couple quarters, and then towards the third or fourth quarter, I expected a big rally.
But what's the OPEC cut has done has pushed that up to May 1st. So everybody was expecting it to be in the third quarter. Now it's going to be next month. And another thing to remember is refined product inventories are already way below normal where they should be for this time of the year. I think gasoline's about 7% below. Diesel's even worse at 10% below normal. And we're heading into the summer months. And once you get to May and June, gasoline demand really picks up in the United States and just in the West. You also have jet fuel demand expected to increase. And there's some real shortages in the supply chain, especially for gasoline.
Yeah, I expected this. I didn't know if it was going to happen in the last week or two with the Saudi oil production cuts, but I expected it to happen over the next couple months, because if the oil price had gotten below $67, say it had gotten into the low 60s or high 50s, I mean, we're talking that a lot of global oil production would not be economic anymore.
That's right. And one thing I found out today, I was on another webinar a couple hours ago, and we were importing a lot of the stuff we blend with gasoline to make our high octane premium gasoline. And they said on this, we're very short octane. And so the premium gasolines, there's going to be a bigger price spread between regular gasoline and premium gasoline. And even in the regular gasoline, summer blend gasoline requires or forbids you to put like more propane. Propane's much cheaper, but in the winter blends, you can put about 10% propane in there, and that makes winter blend gasoline's cheaper. So just that alone sends gasoline prices 20 or 30 cents a gallon higher, but they're thinking premium gasoline could go 60, 70 cents higher just because of this lack of octane.
Yeah, interesting. I mean, normally in the seasonality for the refiners, the summer blends are normally more money. Don't they also stick some antifreeze in some of the gasoline in the winter to try to make sure it doesn't freeze over in super cold
I think
temperatures?
there's more alcohol in it and butane and stuff like that. But you can't put that stuff into the summer blend gasolines because it makes it evaporate faster. And they think it causes more air pollution or something. I don't know, but anyway, that alone actually increases demand for black oil, let's say crude oil, by about 1.5 to 2 million barrels a day. Just the difference between the winter blend gasolines and the summer blend gasolines.
So I want to transition now to the comments that the CEO of the Pioneer Natural Resources Company said over the last month. He was talking about the Permian Basin. The production has either peaked or collapsing. I've also seen comments from different petroleum geologists, other different oil experts, and pretty much there's a consensus that the production for the Permian will eventually peak soon, but some people estimates that'll happen in the next year. Other people say 5 years, but overall, it seems that the that the production in the Permian will peak in the not too distant future.
Well, the production growth that we saw in 2022 was because heading into 2022, we had a lot of duck wells. We had a lot of really good duck wells. These are wells that they had drilled. They cased the wells, but they did not complete them because they didn't want to complete those wells into low oil price environment. So they were completing during 2022. We were completing more wells than we were drilling. Well, now all the good ducks have already been completed. So now we're pretty much just completing the number of wells that we're drilling, and you're also running out of tier 1 acreage. And another thing that I saw yesterday was that the private operators, which were drilling and completing a lot of wells last year, they've kind of run out of their really good acreage, and they're not going to be adding as much production as they did last year. So, the large companies like Pioneer, Diamondback, just some of the really big guys that I follow, let's see, Coterra and Devon and those guys, they don't, a lot of their acreage is held by production. They're good stuff. So they don't have the gun to their head where they got to be drilling a whole bunch of wells, this drill, baby, drill mentality. And they're committed to financial discipline. They want to be able to keep paying high dividends to their stockholders. And I think it's going to be very difficult for production to actually increase. In fact, actual production in the U.S. peaked in October last year, and it declined in November and December, about 300,000 barrels a day. Some of that weather related in December, especially, and that normally happens. But I don't think I know we're not back to 12.4 million barrels a day that we had in October. We're probably at about 12.2 or 12.3 maybe, but we're not going to get back to 12.9 this year, which was the pre-pandemic level of production.
Are the companies that you just mentioned in the Permian, are those guys low-cost oil producers, or are they higher cost and they have to drill a lot of wells to offset the rapid depletion at these wells in the Permian Basin and the Delaware Basin?
Well, everybody. I mean, the entire industry is pretty much on a treadmill now as we depend more and more on these horizontal shale wells. Our conventional production is less than 4 million barrels a day now, and it is on steady decline. I mean, we're just not even completing that many more conventional, vertical conventional wells. So it's all these horizontal shale wells, and they all do come on strong and they deplete. So when you just think about it, you're just going to keep layering on more and more and more of these high decline rate wells. Now they're still really good. I mean, at $80 oil, these things pay out in like 8 or 9 months. But they'll come on at 1,200 barrels a day, drop to 500 barrels a day by 6 or 8 months, and then they, they flatline at maybe like 150, 200 barrels a day, and they'll be good produce, they'll be more than covering their operating expenses for many, many years, but they don't produce near what their flush rate of production is. Most wells on a shale wells, you can expect them to produce more than 50% of the oil they're going to ever produce will be produced in the first 2 or 3 years.
And those wells are not economic at $50, $55, even $60 a barrel West Texas Intermediate?
Well, once they've paid out, the lifting costs on these wells are only like $12 or $13. They're pretty much flowing wells, so that you just got your production taxes and the pumper fees and stuff like that. So they're still cash flow positive down to even $15 a barrel. But I mean, to actually pay out the drilling cost, of course, they got to come on really strong, because these wells cost $7, $8, $9 million to drill and complete.
Okay, so if you were to amortize that over a lot of wells, I mean, I don't think a lot of these shale producers would be economic at $40, $45, $50 a barrel. Only the lower cost guys, maybe for a couple quarters, they could stay at those levels if they hedged at higher prices or something. But I think the industry, there would be big production declines then.
Yeah, well, they would just stop drilling new wells, because what would happen if you get down to $40 oil, that well may never be able to pay out the drilling cost at $40 oil. But once a well's paid out, it can stay online for a long time. I mean, there's a lot of wells out there that are only making 5 or 10 barrels a day that are actually economic because they paid out a long time ago, and you're not going to plug them as long as they have positive cash flow.
Okay, so if the Permian Basin, the oil production does start to peter out very rapidly, say in the next year or two, where do you think the additional oil production growth to offset that somewhat is going to come from?
Well, there isn't much in the U.S. I mean, there's the Bakken up in North Dakota. That's the Williston Basin in North Dakota is where the Bakken shale is. It's already past its peak. The Eagle Ford as a entire zone, an entire area, is already it's much, much smaller than the Permian Basin anyway. So a lot of that tier 1 acreage there is already drilled out, and so it's past its peak. DJ Basin's got, can remain flat for a while. Now the Powder River Basin in Wyoming has got some additional upside, I think. But then you got to be looking at, offshore Gulf of Mexico. And I mean, you're fighting the Fed constantly if you're in the offshore. There was at one point, I mean, prior to Macondo, I mean, you go back about 15 years ago, the Gulf of Mexico was responsible for about 50% of the world's production growth. It was the oil growth engine back then. And it's still a lot of potential in the Gulf of Mexico, but my goodness, it's to operate out there. You're, fighting all this federal regulation crap all the time. So it's difficult. The Permian Basin still's got a lot of upside. I mean, if oil would go to 100 or something, these guys could really ramp up production, another couple million barrels. But we're not going to be able to have the production growth like we had in the early days of the shale revolution, you can call it. I don't think we'll ever see U.S. production over 15 million barrels a day.
Yeah, I mean, the Saudis can't even really get there, and they have the lowest cost field, or at least in the past it was a low. Yeah, we were talking about that before we started recording about all the water injections into Guar. So the Saudis still throw around, and some oil experts still throw around that $15, $20 a barrel for cost. I mean, the Saudis have been water injecting those wells at Guar to try to maintain production levels and offset the depletion rates for years. So there's no way that those wells cost only $10, $15, $20 a barrel anymore.
Yeah, no way. They and you got to think of Saudi Arabia think of the country as a company. They not only have to pay for the drilling, completion, operating of all these, oil and gas fields, they got to pay for all the social programs that they supply for all their people, all the subsidies. So it's like one big thing. I mean, it isn't like if Saudi Arabia's oil production goes on steady decline, it isn't like a bunch of banks are going to line up to loan them a bunch of money. They don't really have much of an economy other than oil. So that's it. They're trying to develop more of a natural gas business, and I think there's some upside there for them.
Yeah, I think the average person who's listening to this podcast doesn't understand how oil production in Saudi Arabia works. So they actually hire a lot of foreign oil service workers to drill and complete wells and do the oil services. So Saudi Aramco, you have Saudis at the top of Saudi Aramco, the oil minister, and some of the other people, but there's not Saudi construction workers. There's not Saudi roughnecks. A lot of those employees are foreigners. at low, they're considered low skilled labor and they're paid low wages. But then also for the regular oil service employees, you don't have a lot of Saudis there too. It's a lot of foreigners who are living from the US or other oil services companies at Halliburton or Schlumberger who have decided that, oh, I'm going to make 6 or 7 figures a year living in Saudi Arabia for, I don't know, 3, 4, 5 years. And then I'm going to bring all that cash back to my home country.
Yeah, build up your retirement account and then move back to the U.S. Hey, at Hess, we had the same thing. We had people agreeing to, go on the overseas, and they get like a 50% pay increase to go work in the Middle East or someplace in Africa or something. And they just looked at it as a way, okay, I'm going to suck it up for 5 years, do this, and, build up my retirement account.
Well, there's also, isn't there a hazard pay for working on a deep water offshore rig? Because it's so dangerous and there's so many things that could go wrong. And even like if you need a new tool like an emergency screwdriver or a hammer or something like that, sometimes it has to be either boated or helicoptered in. Depends how big the emergency is.
Yeah, it's expensive operating. Now, the guys that actually work on the production platforms, I don't consider that real dangerous. We had a lot of them. We had at Hess about 25 operated offshore platforms and never really had any risk there. And when you're drilling the wells, now that like when you had the Macondo blowout and everything, that's not your production workers doing that. You bring in a drilling company to do that. Some of the big who was the ones that did the offshore one. But anyway, a lot of the big offshore drilling companies, those are the guys that come in and drill your wells. And that's where you got some, danger of a blowout or something like that. But the actual, once the production facilities are all installed, it's, they work a week, they're off a week. They're out there on their platform all by themselves day after day. But anyway, some people really like that kind of lifestyle.
So actually, we also talked about this before we started recording, that the geological formations, obviously the geological formations are not going to care about a border between the US and Mexico. So there's actually a lot of good shale plays in Mexico, but you and me are both in consensus here. I don't think they're going to get drilled, unfortunately.
Well, if you look at a map of the Eagle Ford Shale, and it actually gets bigger as it approaches the Mexican border, and it extends over in Mexico. But those states that border the U.S. are all controlled by cartels. And I went to a meeting 4 or 5 years ago about how Mexico was going to open up to, U.S. investment, U.S. drilling companies. And I left that meeting thinking nobody in this meeting is going to move their people and their expensive drilling equipment into onshore Mexico. Now, offshore Mexico is got a lot of potential too. But one of the companies I follow is Talos, Talos Energy, and they actually got concessions from the Mexican government to drill in shallow water, I think about 150 feet deep or something offshore Mexico, and they're really experts at that kind of shallow stuff. And they made a major discovery called Zama. Well, then they have an election in Mexico and the new president comes in and he decides to take away operatorship from Talos. They've been in a fight for like almost a year and a half. And finally they
was it
kind of agreed. Then they nationalized. Well, they elected the government, forced Talos to let Pemex take over operations. And they really don't have the expertise to do it. I mean, Talos is a great operator. But they've recently agreed to jointly operate it, although the National Oil Company of Mexico is going to have final say-so on everything. But I think Talos is going to have a lot to do with the engineering and actually completion of the field.
There's been a lot of actually anti-natural resource policies and anti-investment. I think I just saw in the last week or two that the Mexican government was talking about a new 10% tax on Mexican copper, gold, and silver miners. So that's being proposed. And then in some of these mine areas where they're close to cartel towns, I mean, there's just been stories of the bullion that's on site. The doré bars are routinely stolen. So these mining companies that are close to the cartel areas, they have to hire extra security, and then there's still thefts. So it's just, I don't know, Mexico's becoming, I wouldn't say it's totally off limits for investment, but it's becoming less and less and less unless you want to spend a ton on security to guard like your mine areas. So if you're actually mining like really good grades of copper, gold, and silver, you have to have extra security to guard the metal on site and then also transport the metal to an airfield to get it out of the country.
Yeah, and it's too bad. I think Mexico's got a lot of good natural resources. I mean, all through South America, that's where you get a lot of the copper mines and lithium mines and stuff like that. And I do follow a few Canadian mining companies that are doing some stuff down there. So, but I don't know. It wouldn't be high on my list if I was running an oil company.
The other thing we wanted to talk about was Mexican oil demand, because I know you go to Mexico a lot for vacations since you're in Texas and you like going there for vacations. They've subsidized as a policy. They've kept oil prices, at least for decades in the past, with Pemex, because they had that Cantarell field. That was a major discovery back in the 1970s. It was one of the largest oil field discoveries. But now the Cantarell field has sputtered out. That field has peaked years ago. And now Pemex is basically going to not be a net oil exporter. The country of Mexico is not. A lot of that, though, the average listener doesn't understand this on the demand side, is because the Mexican government and Pemex has subsidized gasoline and diesel for so many years at artificially low prices.
Yeah, they have for a while, but it's come up, and we go down there a lot, 3 or 4 times a year. And their gasoline price, I was surprised. It's kind of come up quite a bit just in the last year or so.
So if Mexican shale is not an option, and then the U.S., a lot of the shale plays are going to start petering out unless we get oil over 100. You think then deep water Canadian oil sands would be an option for oil production growth?
Oh, yeah. Yeah, I do. And I think if we would really work with Canada and, wouldn't, let them halfway build a pipeline and then not let them complete it, that didn't go over very big. But I mean, we could definitely be North American energy independent if we would work together. And, I tell you, if I was president, that's what I'd do immediately. Say, hey, let's quit worrying about the Middle East and all this stuff, and let's just be, energy independent among our friends here and work together. Maybe we can clean up Mexico or something a little bit and that open that up too. But there's definitely huge oil reserves up in Canada, especially if you start talking about $100 oil. Then the oil sands plays. They're very expensive to get going, but once they're going, because they have long live reserves, there's a lot of oil to be recovered up there in Canada.
They could also build more liquefied natural gas export facilities up in Canada, but it's a real pain in the ass for them to get approval. I think they just got a small one approved a few years ago, and it's under construction now. I think it's Tourmaline, that's not that far from Vancouver. So they're the largest natural gas producer in Canada. So this is not Suncor or one of the other Canadian oil sands plays. Suncor is like the largest, but Suncor and Canadian Natural Resources, they're buying up tons of acreage and doing mergers and acquisitions now. So they're taking advantage of the cheap valuations to do mergers and acquisitions. But Tourmaline, I think, is the only one that's able right now to export that cheaper Canadian natural gas and get a much higher price. Well, soon, once that liquefied natural gas export facility is online, they already have really large contracts with Cheniere Energy negotiated.
Yeah, the gap between the international gas prices, which even now they pulled back. I mean, you're still talking Asian gas price of $12 compared to our $2. European gas, I just saw today, was like $15 delivered for LNG. So there's still a huge profit margin to get gas into those markets. And our LNG export facilities are running at max capacity. Freeport's back online. We're back up to about 12 billion cubic feet a day of LNG exports. That's going to help get our supply and demand for gas, balanced again. There's lots of gas reserves. I mean, I really don't understand why we're not talking about expanding compressed natural gas for vehicles. Like if we could get like half of our big trucks, our 18-wheelers on the highway, instead of running on diesel, they ran on compressed natural gas. That would save a lot of pollution, since natural gas burns so much cleaner than diesel. But also, we are sitting on hundreds, even thousands of trillions of cubic feet of recoverable gas in the United States. I mean, the Eagle Ford hasn't even been tapped yet. You still got a lot more gas to be recovered from the Permian. And it's just, getting the government to approve more pipelines and infrastructure for the gas network.
I think you have in most major cities now in the United States, you have some of the metro buses that run on compressed natural gas, but that's just the metro buses. So, and it's not the entire fleet of metro buses, it's just some.
Yeah, I went to a meeting 4 or 5 years ago, actually, when natural gas was really cheap then too. and we had trucking companies there, and we had the natural gas producer there, and they were talking, what's it going to take to get the trucking companies to convert their fleets over to run on compressed natural gas? Well, number one, you got to build out the delivery infrastructure. So you have to build a whole bunch of compressed natural gas stations along the freeways, because you can fill one up, fairly quickly. It's not like recharging a Tesla that takes 4 or 5 hours, but the infrastructure doesn't exist. But it would be a lot cheaper to do that than it would be to build, tens of thousands of windmills and these solar farms and stuff like that. If we could convert half of our fleet of trucks to natural gas, man, that would be a big saver of oil. And I think in the long run, we'll do that because, as we discussed earlier, sooner or later, oil production is going to peak in this world. It can't just keep going up, 1 million barrels a day, 2 million barrels a day, year after year after year. You're just running out of the cheap stuff, and oil is going to get real expensive in the next few years.
Do you think the Freeport liquefied natural gas export facility back online, is that going to deplete all these natural gas inventories that the U.S. has? Because a lot of natural gas bears are saying that, the U.S. has way too much extra natural gas supply. There's going to be a bear market in natural gas for at least a couple years now. Even if those liquefied natural gas export facilities from Freeport are 100% back online and new ones are built, still not enough. The inventories are not going to deplete enough. What are your thoughts on this?
Yeah, we don't have a lot of new demand coming online until second half of 2024, which is, it's 18 months away. It's not like way out there. But starting in the second half of 2024, we're going to have, lots of new LNG export facilities. We're going to add about 12 billion cubic feet a day of export capacity from mid 2024 until 2027. There's going to be a big surge in natural gas demand. Not only that, one thing that's going to kind of balance the market is you're already to the point where switching the natural gas power plants that can either run on coal or natural gas are going to switch to natural gas. That's already happening quite a bit. And you're even to the point where in Texas, we have these natural gas peaking plants that only run in the daytime to generate electricity for air conditioning. Natural gas is so cheap at $2 now, it's profitable to run those peaking plants 24 hours a day now, even in April already. And so that's going to chew into the surplus of natural gas have. It's not a big surplus. If Freeport would have been online all the second half of last year, it just got back online in March. If it would have been online the whole winter, we wouldn't have a surplus of gas in storage. We'd have a shortage because that's 2 BCF a day. So just take 8 months and multiply it by 2 BCF a day, and that would be like 400 BCF less gas we'd have in storage. So you'd be below the average instead of above the average, and the gas price would have probably held in the $4 or $5 range. But right now, it's going to take a while to get the market back in balance, but it will. And what'll happen is the upstream companies that produce a lot of gas, they'll not complete wells. They'll drill wells, they'll case them, and they'll wait till the price goes up before they complete those wells.
Yeah, I agree. I think a lot of supply is going to come offline, but to your points there, the natural gas futures curve is actually predicting a much higher natural gas price 12, 18, 24 months from now.
Oh yeah, you can like right now, you can go and look at the futures contracts for December, January, February, and they're pushing $4. So if you're a natural gas producer, you can go lock those prices now. Right now, you could hedge those months and get that price for your gas. So they'll work things out. It's, we're not that big of a surplus. It's not like storage is full. It's a little bit more than it used to be. It should be at the end of the winter, but it's not like it's full. We still have 2 TCF of empty storage sitting out there. So there's not a glut of oil. There was a glut of futures contracts that had to be worked off, and that should have taken place already. So we should start seeing the natural gas price ramp up, and you get a hot summer. Once you get into the hot summer and all these gas-fired power plants come online for the summer, it'll eat into that pretty good.
And about a month ago, we had you on for another interview, and you were talking about the low-cost U.S. natural gas producers, including EQT, and then also Jerry Jones's natural gas producer, which you said was around $1 production cost.
Yeah. He's like the lowest gas producer because those Haynesvilles come on real strong. Now, the problem with the Haynesville gas is it's very dry. It doesn't have a lot of NGLs in it. So the NGL prices are much higher. So if you hear them talking about liquid rich gas, like EQT has areas of the Marcellus and the Utica where they have some very liquid rich gas. So that has propane, butane, that in it. And those prices have come back, but they haven't gone down as fast as the gas price. So yeah, the long term, the natural gas producers, I like EQT, Coterra pays a really nice dividend, and there's a lot of these companies like EOG produces a lot of gas, they pay a nice dividend. Pioneer produces a lot of gas and pays a really nice dividend. So I would keep some exposure to natural gas in your portfolios. And the one thing that's really funny, if you run a 25-year chart of natural gas, the natural gas price spikes, 80% of them happen in the summer months. They don't happen in the winter. They usually happen because of a fear of not being able to refill storage. I don't think you're going to see that this year, but you never know when these price spikes can happen. Maybe the situation in Europe gets worse, and we really have to export more and more, natural gas, as we're already up to we're about maxed out now, but anyway, the long-term future for natural gas is there. It is the clean fossil fuel, and it's what we should be doing more and more of, is figuring out ways to use all that energy.
Are those producers that you just mentioned, like EOG, maybe Devon Energy, Pioneer Natural Resources, are they around 50-50 mix for oil production and natural gas production?
No, Pioneer, Diamondback, they're more heavily for oil. Devon is probably closer to 50-50. Yeah. But they're getting a lot off their oil production now too. And they've got a bunch of their production hedged anyway. The ones that are really heavily weighted to gas would be Comstock, is without a doubt. It's 99% of their revenues come from the sale of dry gas. That's Jerry Jones's company, and they're a Haynesville company. I will tell you though, they have some fantastic acreage in the Haynesville. So if gas prices do come back, that one's got a lot of upside. EQT is the largest natural gas producer. Antero Resources also produces a lot of liquids. They're a good one. I like Range Resources, is about 70 on a BOE basis. They're about 70% natural gas, but today their revenues are more than 50% from oil and NGL sales. So they're very balanced, and I like them a lot, and they do pay a nice dividend.
So with the valuations, even though we've had oil prices rally a little bit in the last week or so, the valuations on a lot of these oil producers, so these are companies that are still making pretty good money, are very low. Do you expect to see a lot of mergers and acquisitions soon?
Yeah, you could. And I think what I've been seeing is more the public companies buying out big private guys, because the private guys can't raise more capital either. So they'll prove up an area and then they'll sell it. And I've seen some really good deals. If you look at Earthstone, is one of my top picks. ESTE is the symbol on that one. And that company has closed like 5 or 6 private deals, and they've gone from like 25,000 barrels a day of production to, I think their fourth quarter production was 104,000 barrels a day. They're at $80 oil. They're going to be very profitable and very cash flow positive, and they got a lot of running room. I like that one. I like some of these small caps that have quite a bit of running room too. One that's done really well recently is and made a nice acquisition is Riley Permian. REPX, I think, is a symbol, and they made a real nice acquisition that it's a real strategic deal, that the acreage fits in well with their existing acreage, and it gives them a lot of running room out in the Permian Basin. I like that company, and they've got some CO2 flood potential. They're doing a CO2 flood pilot project, and if that thing works out, it could double their recoverable reserves out there.
So that's what, a new enhanced oil recovery technique?
Yeah, it's not new out there in the Permian Basin. When I was at Hess, 30, 40 years ago, we were doing CO2 out there, and it's the San Andreas zone, which is a well-known sandstone. It's perfect for CO2 flooding. The CO2 is mixed with water, and it actually goes in and strips more oil off the rock and allows you to recover maybe another 15, 20, 30% of the oil in place can be recovered when you mix the water with CO2.
But you would say it's cheaper though for a producer. So if you're a small, medium-sized, maybe even a larger producer like a Chevron that has a lot of free cash flow right now, to go and buy another company than to spend billions of dollars on exploration drilling.
Yeah, there's some really cheap ones out there that if you look at their year-end reserve reports and you believe $80 oil is going to be around for a while, they're selling for big discounts to their net present value. I'm looking at one today that it looks like to me it's selling for like 60% of its breakup value right now, because that's what when I was at Hess, I had a group that we were looking at companies all the time for possible takeovers, and we closed $3.5 billion worth of deals in the 5 years I was there. So they're out there.
Yeah, I mean, in terms of sizable exploration drilling, I mean, OPEC spending some, but not near enough of the capex to grow, and they're not meeting their production quotas, as you said. Also, my friend oil hedge fund manager Josh Young over at Bison Interest tracks all this. So there's wonderful charts on his email list over at Bison Interest tracking that OPEC is not meeting, a lot of the OPEC producers not meeting their production quotas. But in terms of exploration drilling, I mean, ExxonMobil and Hess, they're having a lot of successes in Guyana, but there's not a lot of other exploration successes globally where they're finding these large fields.
No. You look at IEA's projections; they were forecasting that half of this year's global production growth in oil was going to be coming from the U.S. I don't see it. I think they've grossly overstated what our potential is here, and I know they've understated demand. I mean, if you think the Chinese economy is going to come back online, which everything points that it is, ramping up, it's going to be a real tight oil market within just a few months.
Yeah, like Argentina's national oil company was bragging about how they're going to basically double their oil production growth from their shale plays there, but it's only growing by about 500,000 barrels a day total over about 5 to 7 years. So, I mean, 500,000 barrels per day for the global oil market in relative comparison for our listeners out there, that's not a lot. So if shale production starts falling and sputtering out, that Argentinian oil production doubling to 500,000 barrels per day, it's not going to offset the shale depletion.
No, I mean, it won't. You got to keep adding 1 million to 1.5 million barrels a day just to keep up with demand growth. And I was on with U.S. Energy Development. They're a large private company that raises $200 or $300 million a year for drilling programs, and they operate out in the Permian. And we got to talking and said, these projections that global oil demand is going to go to 104 million barrels a day by the end of this year. We both said, where the heck is that going to be coming from? Because we don't see that much oil. Even if all of the OPEC spare production that they say they have, and I doubt they actually have it, comes online, there's not enough to meet that kind of demand growth.
Well, the Saudi oil minister a couple months ago, and this was before the production cuts, before they did more, and I was predicting more production cuts at one point. I didn't predict them this soon, but I was predicting probably a couple months from now. The Saudi oil minister was honest, and he said, look, we do not have any more spare production capacity if Chinese oil demand comes back. He's like, basically, we're running at about max capacity now, and we do not have any more spare production capacity. And in terms of spare production capacity, I mean, maybe United Oil, UAE, United Arab Emirates, and a couple other have a small amount, but most of the other OPEC producers do not have spare production capacity, anything close to the Saudis.
Yeah, 2/3 of the OPEC countries are pretty much on decline. They can't make their existing quotas, the smaller countries. So there's just a handful of the Persian Gulf ones. Iran's got some upside, obviously, Iraq, UAE, Kuwait a little bit, Saudi Arabia. I would say from those five, that's where your upside is going to come from within OPEC.
And you also talked in that presentation that you did in the last 10 days about Russian oil production. And I mean, that started they cut production, I think, by about 600,000 barrels a day, something like that a few months ago. Yeah. And we could see further production cuts on its own just because they don't have all the free cash flow to reinvest back into that right now. Because they were expecting a lot of extra income from the Nord Stream pipeline, and it's just not there. I mean, they've had to discount pretty heavily the oil to Russia. I think even Japan was buying some of that oil now lately. I think I saw that Japan was skirting the U.S. sanctions and was buying Russian oil lately too.
Yeah, I just don't think they're going to have it after a while because without the money to keep pumping into those fields to keep up the repairs and maintenance out there, and drill new wells. They have to drill new wells too. Their production is going to go on decline. And this, the Schlumbergers, Halliburton stuff, they pulled out of Russia. So the American service companies are not in there now. So they just don't have the people. They don't have the equipment to maintain their production level. So it's going to decline all by itself. Boy, I don't know how that situation irons it out. I sure wish we were having regular negotiations to try to settle that situation in Ukraine, because I don't know how's that going to get solved, but it's not good for the global oil supply. That's for sure.
Yeah, I think there's going to be supply problems coming out of that. I just don't see a lot of new supply coming online from, well, Ukraine was a main middle depot there. A lot of the gas was piped through Ukraine. So, and then you have the Nord Stream pipeline problems, and Germany's ordering all this expensive liquefied natural gas. I think they're on their third floating liquefied natural gas import terminal, and then they're building new import facilities for liquefied natural gas. So I just see a long term, you're looking 5, 7, 10, 15 years out, all these countries are announcing press releases. We're going to build a new liquefied natural gas import terminal, but like none of them want any domestic oil and natural gas drilling. They're making it very difficult to get any approval or foreign direct investment for actually drilling in their own country.
Yeah, there's actually some very good rock sitting under good shale underneath Poland, and they won't allow them to drill.
Paris too, yeah. The city of Paris. The city of Paris. There's a giant shale deposit under the city of Paris.
There is.
It'll never be drilled.
Yeah, it'll never be drilled because they won't allow it. You think we have environmental wackos? They got about 10 times worse than we've got. North Sea oil production is on decline. Europe's got problems, and they would rather import dirty oil from Russia or wherever than drill in their own backyard. That's the problem.
Yeah, so when the oil price of West Texas Intermediate was around 67, and there were all these people saying, oh, oil's going lower, it's going to crash down to 50. I was like, not for that much longer, because a lot of supply will be coming offline, and then a lot of this production will be very uneconomic, and you'll see similar stuff. I think it's going to happen first and in natural gas. So you're going to see more natural gas supply here in the United States and Canada come offline first. But if oil prices do correct again and get down to that 67 or lower, I think you're going to see a lot of supply come offline.
Yeah, you would. I can't see oil going back to 50 or anything like that. It would, because we're already low. Remember, back there in the beginning of the pandemic, we had all of our storage filled up. We had all kind of above ground storage, and there was no shortage of gasoline. There was no shortage of diesel. But now you're looking out in the world, and everybody, all through the OECD countries, there's low inventories of gasoline, diesel, distillate, jet fuel all around the world now. So there's just no way you can get oil going back to 50 for any length of time. The risk is definitely to the upside on oil.
Well, especially if the oil service companies, and they've been talking about this in the earnings call, they all want to raise prices for drilling wells and completion because their input costs are up. They want to bring back new workers, and the workers, if they're unionized, they want higher wages to at least partially offset inflation. So all the companies that do all the drilling and all the other oil services all want to raise prices. So that's going to, and then on top of this, you have higher cost of capital.
Yeah, I'll tell you, I talked to a lot of CEOs of these public companies, and they're all complaining about how difficult it is to find good quality people. And, the industry has been badmouthed so much. You don't have people going into petroleum engineering, petroleum landman school anymore, petroleum geology anymore. It's going to be a problem. And as the workforce ages and more of these guys that have really know their stuff retire, that's going to be a problem. So I don't know, sir, but the service costs are kind of going to plateau here, I think, a little bit. We do still have some tubular shortages, supply chain problems with getting casing out there, but anyway, they're going to work through that.
So if the oil prices do crash, what we've seen in past cycles, though, with these service companies is for any type of business at all, they'll slash prices, but that's only temporary because then those service companies are going to be cash flow negative and they're not earning a profit margin. So for any business, they're sacrificing that to get any revenue at all, and that's not sustainable either. So no,
that's not sustainable. And the upstream companies know that. They know they're kind of in partnership with the service companies. They rely on them very much, and they usually work really well together.
So in terms of low-cost U.S. oil producers, do you think that Pioneer Natural Resources is one of the lowest cost ones?
Yeah, they're good. I'm just looking at their model right now. Their production's up to about 675,000 barrels a day. You were asking what the percentage was. It's about little over 55% crude oil, about 20% NGLs, that's natural gas liquids. So, what's another, and maybe 25% natural gas. And they don't hardly have any of their production hedged. So this natural gas pulling back is going to hurt them, but the oil price will more than make up for it. So if Raymond James just increased their oil price forecast, they've got $105 WTI in the fourth quarter. And Goldman Sachs has also raised their oil price for the fourth quarter again.
So for our listeners out there who are reliant on dividend income, what this probably means, what Dan just summarized, is that the variable dividend that Pioneer has, because I think they have a base dividend and then they have some type of mathematical formula depending upon oil and natural gas prices for the variable dividend, that at these natural gas prices, the variable dividend is going to be cut a lot.
Yeah, but I just looked at them the other day, and my estimate is that their dividends for 2023 will total $21. So the stock is about at 200. And so you're still looking at a 10% dividend yield on that stock. I have 5 upstream companies that I really like for dividends. Pioneer, PXD, PDC Energy, which does have production upside and pays a real nice dividend and is trading for a low multiple cash flow. Its symbol is PDCE. Its dividend yields about 6.5%, 7%. Diamondback, which is FANG, FANG, has about a 7% yield. So there's some really. Devon is about 8%. The one that's going to take the biggest hit on their variable dividend this year is Coterra, because about half of their production is natural gas. So they're going to take kind of a hit on that. I like the royalty companies. Actually, we just published a new newsletter. So if any of your listeners want to join Energy Perspectives Group, I just went through and spent a week going over every one of these models to determine what I thought their dividends were going to be this year.
So that industry for the oil and natural gas royalty companies is a little different than the precious metal one, but there's been a lot of consolidation there too. So you had Cintio merged with Bergam, and then we've talked about this on past interviews, Venom was also consolidating the industry. So the two largest ones, are they Cintio
and
now?
They're oil weighted. Those two, STR and Venom is Viper Energy Partners is VNOM is our symbol. And they're both, paying 7.5 to 8.5 dividend yield. My top pick in that group would be STR. Because the market still hasn't really seen the full impact of the merger with Brigham, and it almost doubles their production. And they're going to be the biggest royalty company out there. And and especially if you think oil and gas prices are going up, these guys they have very low cash expenses, and they pay out a very high percentage, 60 or 70% of their free cash flow is paid out in the form of dividends.
For our listeners out there too who own a lot of precious metal royalty and streaming company shares, I believe Franco-Nevada has about 10% of their annualized cash flows are from oil and gas royalties. They bought a large portfolio from Harold Hamm when he right after his divorce. I think they paid a couple $100 million for it. He was kind of in a financial crunch, and Franco-Nevada has that cash, so they just wrote him a check.
Yeah, but he took his company private. Continental's private now.
Oh, I didn't know that.
No, they just about this 3 or 4 months ago. He took the company private, CLR. He got tired of all the public BS and he had to deal with. No, but these guys are all going to be fine. They're going to make it. Even the gassers, I think they can survive another year of $2 gas. They did it for many years, and they all cleaned up their balance sheet. They really got strong balance sheets coming into this year.
And I think also if you're a large producer that's lower cost and you have a lot of cash on the balance sheet, you're running these valuation models right now. And it's just cheaper to go and buy a producing company and go buy those oil and natural gas reserves if you're thinking long term, than invest a lot into exploration drilling. Because if you're a larger company, your cost of capital is cheaper, and these smaller companies might not be able to get the funding.
Yeah, that's a very good point, because if you take EOG, that probably has the lowest cost of capital. I mean, they can borrow whatever they want for $5, and they don't need it. They're generating massive cash flow. They could go buy one of these smaller companies that probably, if they have to borrow money, it's 8 to 10% or something like that. They would go in there and immediately just pay off all that debt. And so that would be immediately accretive to a big company like EOG. Now, EOG doesn't need it because they have a massive amount of, undrilled locations, like 10,000 high return drilling locations already, but they could still do it if they can, it's going to help their balance sheet. They can do it.
Well, if you're going to have hedge fund managers, global macro guys, right, that are like, the global economy is in a recession or depression, I'm shorting all energy. And that's kind of, I think, what happened over the last 4, 5, 6 months until the Saudis announced an oil cut to stop that. But there's just a sentiment out there that we're hitting deflation. You don't want to have any energy plays. I've had discussions with some of these guys on Twitter. They don't want to hear anything about the supply side problems of production costs. They don't want to hear any of that. Their whole thesis is deflation, global macro crisis, banking crisis, short energy. I'm going to go sit on a beach somewhere.
I tell you, if Raymond James is right and Goldman Sachs is right and oil hits $100 in the fourth quarter, some of these guys that are shorting these oil companies are going to get crushed. They're going to get crushed. And I think that's one of the reasons that the Saudis did their production cut. I think they wanted to punish the short sellers.
Yeah, this production cut, I think, is different than the stuff that the Saudis pulled during the shale bubbles. The shale bubble in like 2013, we were talking about this before we started recording. So I think the Saudis back then, they did try to do some production cuts back then too. But then the shale companies, because the capital was so cheap and easily available back then, the shale companies were just taking their market share, and they weren't focusing on profit margins or free cash flow, and they were growing. They were drilling every single well they could and growing, and Wall Street was rewarding them with higher share prices and valuations and stuff. But then the Saudis did a 180, right? So then they decided, hey, that wasn't working with their production cuts, and the shale companies had gained market share. The Saudis then increased production and tried to bankrupt the shale producers. So by like 2015, 2016, there was a ton of bankruptcies.
Yeah. But it hurt them just as bad as anybody. One way to look at it this way, pre-pandemic, back at the end of 2019, we had about 1,100 drilling rigs operating. Today, we don't have 800. It's like 750 or something total oil, and maybe down to 700 if they're laying down some gas rigs. And we have $80 oil. So, if it was just a profitability standpoint, we'd be back up to 1,100 rigs or something. But part of that is people. I've heard that the drilling companies can't find enough quality people to run these rigs. So you're not going to see huge production growth in the U.S., especially with a government that's bad-mouthing the industry constantly.
Well, I mean, Biden has claimed that he's given out these oil and natural gas leases, but on federal lands, he's made it basically impossible, right? He's pulled a lot of them.
Yeah. I think the offshores really don't trust him at all. So you don't see many people going to the lease sales out in the Gulf of Mexico anymore. Well,
it's kind of the policies a lot of the times from the Biden administration on energy don't make any sense because they're not. He said he was going to refill the Strategic Petroleum Reserve. Obviously, I think that's a lie. I don't think they're going to. So whoever's next in the White House will be stuck with this mess. And then the other head scratcher is they actually approved the oil and natural gas drilling, the projects for the Willow project in Alaska for ConocoPhillips. I mean, Biden and his environmentalist base, there's no way that they'd be happy. There's no way that the environmentalist base and the green energy and ESG people going to be happy about that. So that was kind of shocking, got approval at all in the Biden administration.
Yeah. I don't see, when they announced they weren't going to refill the SPR, because if they would announce that they were going to start refilling the SPR, you would see oil prices go up quickly. That would just add to demand. So I don't think they could do it. That would send gasoline prices even higher in the second half of this year.
Well, his environmentalist base doesn't want that. They don't want, I mean, there's tons of hedge fund managers that are ESG focused, and what they try to join the board of directors for ExxonMobil and try to stop ExxonMobil from investing in oil and natural gas.
I know. Yeah. Yep. I don't see him doing that.
Well, I think that's going to mean even less investment in supply. So this supply side problem that people like you, me, and others have been talking about the last 2 years, I just think it's going to be exacerbated going forward, because for a lot of these oil fields, you have to invest many billions of dollars. ExxonMobil's investing billions of dollars to grow their deep water offshore, for Guyana, same thing for Hess. So these things take a long time. It's not like a shale oil well where you can get production in 6 weeks?
Yeah, when you try to do business in those other countries, and I saw this at Hess, everything seems to take 3 or 4 times longer. just to get the infrastructure, get all the stuff in there, get your platforms built and everything. It's just everything takes longer in foreign countries. No doubt about it. Like this Zama field that Taos, discovered from Mexico. It's in shallow water. They were talking about, we'll get some, used platform and set it there and we'll bring these things online pretty quick. That was like 3 years ago. I mean, this stuff just gets embroiled in these political fights and they never get anything done. Doing the one good thing about doing business in the U.S., man, you can ramp it up pretty quick. If you got the leases and you got the drilling permits, you can do it pretty quick.
Well, as long as you're in states like Texas or Oklahoma, I mean, if you're in like an environmental estate, California has shale wells. They're not going to, a lot of them aren't going to get drilled though.
Yeah. Hey, I would tell you, like, this PDC Energy, it's a Colorado. The DJ Basin is primarily in Colorado. And there's a lot of the belief that the environmentalists control Colorado, but that they know where their revenues come from. They get a lot of revenue off the oil sales out of the DJ Basin. And it's one of the top 5 oil basins in the United States. And they just approved, the government of Colorado just approved their drilling program. I mean, they got, several years of permits approved at one time. And I thought the market would react more to that. But your listeners should look at PDC Energy, and it pays a very nice dividend. It's one of our big dividend payers.
I was actually going to ask you if there's a specific play in Colorado that has more acreage.
Well, the TJ Basin is pretty much leased up, but PDC Energy and EOG is out there also. I don't think they're 1 and 2. Somebody's probably above, but number 2 is PDC Energy, and it's a big company. I mean, it's like 400,000 or 500,000 barrels a day of production. It's a big deal. It's one that, for its size, you hardly ever hear anything about it, and it's got a super strong balance sheet, super strong cash flow. There's nothing wrong with that company, and it's trading for like 3 times cash flow, which is insane. It should be trading for 6 or 7 times cash flow.
Sounds like they're an acquisition target then.
Oh yeah, it is. But then some of these other countries, they don't want, for some reason, don't want to get into Colorado politics or something. But they've been there forever. I mean, they've been for decades one of the top producers in the DJ Basin.
So as we wrap up here, I have one more question. I want to ask you about income for pipeline companies, because we have the Fed raising interest rates still. It sounds like the Fed's going to keep raising interest rates, but I'm very wary of U.S. government finances. I do not think that the U.S. treasuries are fully risk-free. There's a lot of people that are buying short-term treasuries. Do you think that a lot of these pipeline companies, maybe some of them have cleaner balance sheets and are paying out a pretty high yield? Are they relatively safer than you would say a lot of these people that are looking for U.S. Treasury for income?
Yeah, the ones that I like that are in our high yield income portfolio, I like One Oak, which is a 100-year-old company based in Tulsa, and it pays like a 6.5% dividend yield, and it's trading for like a $10 or $12 a share below my valuation right now, all through the middle of the country. And they are a big gatherer and processor of NGLs. They're like the biggest in central Oklahoma and in the Bakken. They have big facilities, and they're in the Permian Basin too. I also like Plains All American. Now, Plains All American has about an 8% dividend now, but they have publicly said they are going to raise their dividends until they get up to a certain level of distributable cash flow. And so I think they're going to be raising their dividends year after year by about 15% to get up to their distributable cash flow, because they had some really big capital projects out in the Permian Basin that are now completed. So they are generating just a ton of free cash flow now. So that's one to look at. And it trades as an MLP, that's PAA, but it also trades as a C Corp, if you don't like owning MLPs, as PAGP. That's the general partner of Plains All American, and that's the one I recommend. Then, so you don't have to deal with the K1 from an MLP.
So, what, in your opinion, are the major risks for some of these pipeline companies? Is it that the plays where the pipeline is, so say in the Bakken or a natural gas rich area, is that the drilling activity, the volume through the pipeline stops, or are there other risks like a balance sheet risk for some of these companies? Because I think there was one of the pipeline companies, maybe it was Enbridge in the last like 4 or 5 months, and one of them was playing around with variable interest rate debt on their balance sheet, and they got in some trouble.
Oh yeah, I don't follow Enbridge. Yeah, there's some of them that took on, and they can handle a lot of debt because they have really long live assets for one thing. But Plains' balance sheet's in good shape. Oak's balance sheet is in really good shape. Their risk is that you would have a recession, so that demand for their products would go down, because these guys are basically toll takers. They don't really have commodity price risk, other than if oil and gas prices go really low and they, in those areas, they quit drilling and completing wells, the production will go down. So as long as the production's maintained, these guys are in really good shape, and they have long-term assets that are going to be generating positive cash flow for a long, long time.
So the risks then, you'd say, are volume risks, that if we're the pipeline, the oil and natural gas fields, the play, so Marcellus, Utica, some of these other fields. So if it's a higher cost field and the producer, say Chesapeake, which we've seen in the headlines, announced that they're already starting to cut production. So any of those pipeline companies, if they have a higher percentage of their production volume, of their pipeline volume built in that play, and the production declines at that play, that's the biggest risk, you would say, for these pipeline companies?
Yeah, one of them I think that serves the Haynesville, I think it's EnLink. I'm not sure. I used to follow him, but they took over Devon's midstream stuff, and they call it EnLink, and I think it pays a nice dividend. But they do have a lot of gathering and processing stuff in the Haynesville. I don't think the Haynesville is going to go down that much, but it's also I'd say when you have all those LNG facilities along the Gulf Coast ramping up, they have the most upside exposure because of where it is. It's in Louisiana and East Texas, and so they have direct access and a lot of pipeline access. So if demand for LNG exports goes up, they're in really good shape in the Haynesville.
Do you have these larger pipeline companies? Do you have them as cheaper valuations? So the market's kind of shying away from a lot of these energy plays, like a enterprise products partner, energy transfer partner, and then Plains All Market. So the market, a lot of people are putting their cash into money market funds for income. Yeah. They're looking at U.S. Treasuries, and you think that the income investor is shying away from these energy plays?
Yeah, because they were investing in them before because they said, "Hell, I take a little risk for an 8% yield when I'm comparing it to a T-bill that's paying me 1.5%." But now if I can get what they perceive as no risk on a T-bill of 5%, I don't even know what it is now, but then they'll say, well, now I'm comparing that to 8. So I perceive there's some risk in these pipeline companies, but I'm telling you, they're solid as a rock, these guys. The ones I follow, I follow one small one. It's called Antero Midstream Corp. And the only reason I really like it is it pays like a 9% dividend yield, but it's tied to Antero Resources, which is one of the strongest upstream companies that I follow. And so their growth, Antero Resources drilling program growth feeds into Antero Midstream.
Do a lot of these pipeline companies have a history of growing their payouts or their dividends?
Yeah, I mean, Plains did for a long time. They were growing it every year. I mean, ONEOK they have a long-term policy of increasing their dividend by 8% a year, and I think they can get back to it now.
Yeah, I have friends who have owned enterprise products partners for decades, and they've had a lot of payouts from there. Now, I know Kinder Morgan got in trouble many years ago because they were converting, right? They did it in a really sloppy way with their balance sheet, and then converting from MLP to C Corp, and I believe the shares crashed. But it looks like the industry has kind of figured out how to not screw up like Kinder Morgan recently.
Well, yeah. Well, they got caught up in the frenzy, and oil's going to go to 120, and they were building all those pipelines. And there's still the Permian Basin doesn't have enough pipelines. There still has to be more pipelines built out there, and they were pursuing that. But I think they overbuild and they underbuild and everything. But the industry itself is in pretty good shape, and we're going to need midstream companies. They're like utility companies for us, so you're going to need them for a long time.
Yeah, I'd like to see more natural gas storage tank facilities built, but maybe that's a government-sized project. That probably should have been in the infrastructure package that the Biden administration announced for spending over $1 trillion. They probably should announce new natural gas storage facilities for the Permian and other shale play areas so we can save that gas for the future.
Yeah, well, with the rate of growth of the U.S. natural gas market, which is growing at 3 times the rate of demand for global oil, you can make the argument we need a lot more storage. And to me, the future for natural gas, just because it's so clean burning and everything, is very, very bright. And eventually, as oil gets more and more expensive because we're running out of the cheap stuff, we're going to have to turn more for transportation fuels to natural gas, more for power generation. We make a lot of stuff out of it, plastics and things. The market for natural gas is a long-term market that it's the clean fossil fuel, and I think we should be pursuing it like crazy.
And all people have to do is just pull up a long-term chart of Cheniere Energy, symbol LNG, liquefied natural gas,
right.
And they're the main liquefied natural gas exporter in the United States. They're like the pure play for that, and they're just booking deals left, right, and there's new deals that are coming out every month or two that they're getting with China National Oil Company, a Canadian liquefied natural gas, a Canadian natural gas producer that wants to bring online their liquefied natural gas export facilities, and so they're just booking deal after deal after deal. And with these cheap natural gas prices, if you can actually get the gas via pipeline to a liquefied natural gas export facility, you can make enormous profits exporting it to another country.
Yeah, yeah. And, we see what's happening in Europe, and they need to find new supply. So the natural gas, the LNG global market is massive.
And it wasn't even really there 10, 15 years ago. I mean, it's grown
it's come
so
out of nowhere.
Yeah, I remember Royal Dutch Shell was talking about this in investors' presentations 10, 15, 20 years ago. And people are like, why are you wasting your money? This isn't going to be that serious. It's inefficient and all that. Yeah. Now they proved the market out.
Yeah, well, 10 years ago, we were going to be a net importer of LNG. And now we're a big net exporter of LNG. But we definitely have massive natural gas reserves in the U.S.
Yeah, I remember back in 2006 or 2007, they were supposed to, Putin was talking about investing with the Mexican government and building a liquefied natural gas import facility in Mexico. And then Russian gas from Gazprom was going to go through Mexico via pipeline up to California.
Yeah. Well, we're going to be shipping U.S. gas by a pipeline to Mexico, and they're going to be liquefying it and shipping it out of Mexico. That's what's going to happen, too.
You think Mexico will allow that with private property rights and stuff? I don't know.
Yeah, no, they're talking about building an LNG export facility down there.
Well, they're going to have to guard the pipelines then, because the cartel could easily just hold it hostage and make a bunch extra.
Yeah, I don't know. They got some problems with those guys.
Well, as we wrap up here, I want to thank you so much for your time today, Dan. I really enjoyed our discussion. I think you gave my listeners a lot of interesting stock picks to think about. Could you please tell my listeners about the Sweet 16 at Energy Prospectus Group and also your income portfolio?
Yeah, if you are interested in getting our materials, and we publish a newsletter with 3 model portfolios, we do focus a lot on companies that pay dividends. So if that's what you're looking for, we got a nice list to tell you about. I just published a newsletter. So if you call or send an email to energyprospectus@gmail.com and tell her that you want the Jason Burek discount, she'll probably give you a discount code where you get $100 off the first year. It's our subscriptions are $350 a year. But we're offering $100 for new subscribers if they call and get that discount code. But her name's Sabrina, and send her an email to energyprospectus@gmail.com.
And also, since we're now post-pandemic and we're kind of getting back to normal, you have in-person presentations and luncheons, right?
Yeah, down in Houston, we actually have 3 Canadian companies coming down here starting next week, and a real good one, Surge Energy. About 25,000 barrels a day of production. It's got a lot of upside. They just completed a very nice strategic acquisition that gives them a lot of running room. And so we are definitely having live luncheons. We got 3 this month. We got 2 already scheduled for next month.